For years, we were told that private credit was the safest place in modern finance. While banks struggled under regulation and public markets swung wildly, private credit was presented as calm, controlled, and smarter. Investors were promised steady returns, low volatility, and protection from market chaos. Pension funds, insurance companies, and even governments poured trillions into it. But what if that story was never true? What if the safest corner of finance is now the most dangerous? And what if the next wave of losses doesn't star on Wall Street but deep inside private funds that most people never see? Right now, something is quietly breaking. Defaults are rising, valuations are being quietly adjusted, and large funds are delaying redemptions. Yet the headlines remain calm. There is no panic, no crash ticker, no emergency press conference. And that silence is exactly what makes this moment so dangerous. Because private credit doesn't collapse loudly, it cracks slowly. And then, all at once, to understand why the private credit market is now under stress, we need to go back to where it all began. Private credit didn't appear overnight. It grew out of frustration with traditional banking. After the global financial crisis of 2008, governments imposed strict regulations on banks. Lending rules tightened. Capital requirements increased. Banks were told to take fewer risks and lend more carefully. From a stability point of view, this made sense, but it created a huge gap in the financial system. Companies still needed loans, especially mid-sized companies, but banks were no longer willing or able to lend to them easily. That's when private credit stepped in. Investment firms, asset managers, hedge funds, and private equity groups began offering loans directly to companies. These loans were private deals negotiated behind closed doors, away from public markets and public scrutiny. They promised higher returns for investors and faster access to capital for companies. At first, this seemed like a perfect solution. Interest rates were low, money was cheap, defaults were rare, private credit funds reported smooth, stable performance. While public bond markets went up and down, private credit appeared calm and predictable. This illusion of stability attracted massive amounts of money. Pension funds loved it because they needed steady returns. Insurance companies loved it because yields were higher than bonds. Wealth managers loved it because they could market it as safe but profitable. As more money flowed in, private credit exploded. Funds grew larger, deals became bigger, competition increased, and that's when standards began to slip. To keep returns high, funds started lending to weaker companies. They offered looser terms, fewer protections, more leverage. Loans were issued with fewer checks and fewer safeguards. But because everything happened privately, there were no public warning signs. Then came the long period of ultra-low interest rates. This environment supercharged private credit. Companies could borrow easily. Funds could refinance bad loans instead of recognizing losses. Problems were hidden by cheap money. Defaults didn't disappear, they were delayed. This created a dangerous buildup of risk that few people wanted to talk about. The real turning point came when interest rates began rising rapidly. Suddenly, the foundation of private credit started to crack. Higher rates meant higher interest payments for borrowers. Many companies that had taken on cheap debt could no longer afford it. At the same time, economic growth slowed. Costs rose, profits fell, and refinancing became harder. This is where cause and effect becomes impossible to ignore. Companies that borrowed heavily now face higher payments. Those higher payments squeeze cash flow. Reduced cash flow leads to missed payments. Missed payments lead to defaults. And defaults lead to losses inside private credit funds. But here's the key difference between private credit and public markets. In public markets, prices fall immediately. Losses are visible. Panic spreads quickly. In private credit, losses are hidden, valuations are updated slowly. Funds mark assets based on models, not market prices. That means trouble can grow for months or years before it becomes visible. This is exactly what we are seeing now. Big private credit funds are quietly adjusting valuations downward. Some are extending loan terms to avoid declaring defaults. Others are restructuring deals behind closed doors. These are not signs of strength. They are signs of stress. As the pressure builds, cracks begin to spread. Investors who want their money back face delays. Redemptions are slowed or suspended. New fundraising becomes harder. And once confidence begins to fade, the entire system becomes unstable. Now let's talk about the breaking point. Every credit system eventually reaches a moment where it can no longer hide losses. For private credit, that moment comes when defaults rise faster than funds can restructure or delay, and that moment may already be approaching. Many borrowers in private credit portfolios are highly leveraged. They took on debt assuming stable growth and low rates forever. That assumption is now broken. When even a small percentage of these borrowers default, the impact is amplified. Losses spread quickly through portfolios, fund performance drops, investors panic, and liquidity dries up. The fallout from a private credit crisis would not stay contained. These funds are deeply connected to the broader financial system. Pension funds rely on them. Insurance companies rely on them. Banks lend to them. If private credit funds face large losses, the shock will ripple outward. We've seen this pattern before. In past crises, problems always start in areas considered safe. Subprime mortgages were once considered stable. R-rated securities were once considered untouchable. Each time, complexity and confidence hid risk until it was too late. What makes this moment especially dangerous is that private credit has never been tested at this scale during a high-rate environment. This is new territory. There is no proven playbook, and the usual fixes may not work. Central banks can't easily intervene because these markets are private. Governments may hesitate to rescue wealthy investors, and transparency is limited. That means losses may be absorbed slowly but painful across the system. Now let's connect this to the present. Across the global economy, warning signs are flashing, corporate profits are under pressure, defaults are rising in leveraged loans, commercial real estate is struggling. All of these feed directly into private credit portfolios. The same companies appear again and again across different funds, creating hidden concentration risk. This is why experts are increasingly worried. Not because everything is collapsing today, but because the conditions for collapse are falling into place. High debt, high rates, slowing growth, low transparency. History tells us this combination rarely ends well. So what are the lessons here? First, private does not mean safe. Hidden risk is still risk. Second, delayed losses are not avoided losses, they are stored losses. And third, when too much money flows into one strategy, returns fall and risks rise. The big question now is timing. Will this unwind slowly, or will a sudden shock force losses into the open? No one knows. But what is clear is that the private credit boom was built on assumptions that no longer hold. As we move forward, investors and policymakers will face hard choices: accept losses now, or delay and risk something bigger later. History suggests delay is the more common choice and also the more dangerous one. So here are the three key takeaways. The private credit market is not immune to economic reality. Rising rates expose hidden weaknesses, and the longer problems stay hidden, the more painful the final correction becomes. The warning is simple but serious. The next financial crisis may not look dramatic at first. It may unfold quietly inside private funds, far from public view, but when it finally reaches the surface, the impact could be widespread. If you want to understand what is really happening beneath the headlines and stay ahead of the next financial shift, make sure to subscribe, like this video, and stay with us. Because the most important stories in finance are often the ones no one is talking about yet.